today's video, we're going to do a quick analysis on each of these top 5 car companies. Look at some technical analysis in terms of, these are ranked by revenue. So we're going to look at a very simple trading strategy using moving averages on these 5 companies. Ford is still in decline, but it's making some advancements and broken through its 200 moving average. And it's also, you can see there, the simple moving average 30 is also turning to the upside, so a good sign. So a bit more positive. Once that moving average of the 30 breaks above the 200 moving average, then it's probably in a position to buy Ford. General Motors likewise is broken through its moving average, and the moving average 30 is also making good progression to the upside, so not far away from a potential buy on General Motors if you're following the technical analysis on this one. Mercedes-Benz has had a good little run so far. It's broken above its simple moving average 30 and also above the moving average 200, and it's been that way since November, so making good progress for Mercedes. So that's in a buy position at the moment, and it's making potentially new highs, as you can see there, in the most recent period. Although the highest highs it's done over this particular history of charts, it's gone back to 1998 when it reached 110.40. So we're currently down at this point, so but more recently over the last few years it's almost close to making new highs. Toyota is making some progress towards the moving average 200, although it is a lot more in decline in terms of a share price compared to Mercedes, General Motors and Ford. So, but it is making some small advancements with higher highs and higher lows over the last few months at least. Volkswagen is still in a pretty much a decline in alignment with the moving average 200, although it has broken above the moving average 30 at the moment. So some slight possibilities of making further highs if the market improves, although I would still say it's not worth a buy position at the moment. So first off, we're going to apply a stop loss strategy. So we're looking at a typical 2-to-1 profit loss strategy that is applied by many traders, and we're going to see how that compares with the average down approach. So here we're going to look at a stop loss strategy of taking a profit at 10% and applying a stop loss of 5%. You can see here a couple of examples. This first little box here shows a 10% gain, so that's a take profit of 10%. We open up there at that point at 12.25, and we just hit that 10% mark on that bar there where it reached about 13.47. This little box shows if you entered long there and a 5% stop loss. So it's dropped off by over 5% and it closed out below that. So that would have been a little loss in your trade. So we're using a very simple trading strategy here. This red or pink line and a green line down here is a moving average 200, and this is a moving average 30. So again, we can have variations of different strategies and different techniques, but we're going to use a very simple moving average 30 and a simple moving average 200. So whenever the price closes above both the moving average 30 and the simple moving average 200, we enter a trade, as in this point there, and we close out the trade once it hits a 10% take profit. And when it price, for example, drops by more than 10%, so let's say we enter another entry there, thinking the price is going to go up, but it drops by a 5% drop, then we take a stop loss at that point there. The average down approach, as opposed to the stop loss approach, is this. The take profit, if it gains by 10%, is the same. So if we enter the trade there and it gains 10%, we take our profit. That's a single trade. That's okay. The average down approach, as opposed to the stop loss, is applied as such. So if we enter a trade there, thinking the price is going to go up, but the price drops by more than 5%, we don't take a stop loss. Instead, we wait for the price to appreciate again, start turning up, and we enter it. And as long as it drops by at least 5% and it starts turning up and it's below the 5% level, we enter a second lot of shares there. And in this case, the average price would have been somewhere between there and there. It would have been somewhere there. So we aim for that 10% gain from the average price, which it would have hit there, and that would have been our take profit for those 2 lots of entries made. So that's our average down approach. So now we're going to compare over a decent amount of history going back to 1997. How do we trade the stop loss approach? And this red chart shows the stop loss. So you can see there, each of these bars is basically when a trade is made in a stop loss approach. And this is a profitability chart. So you can see here the profitability rises during that period, sort of levels out a bit. We haven't really made much profit in that period there. Then it starts dropping off because the price starts going down against us. We start dropping off. There's a bit of a gain there in the share price. We take our percentage targets on each of those respective trades, and the profitability also rises. And then the price starts turning down, and their profitability starts dropping. There's no trades made there because it's below the moving average 200, and so on. You can see that the profitability rises, falls, rises a bit, goes level for a while, falls a bit, rises, goes flat, rises and drops off during that period while the share price is declining. There's a few trades made there, but it drops off in terms of profitability because we're taking stop losses. And finally, we're ending up here today. It's sitting at, if your starting balance is 100,000, and we use that just to allow for this drawdown below the 100,000, the ending balance is 1,866. This is the average down approach. You can see there's a bigger drawdown because we've entered more shares in our trading. There's a bigger drawdown from our 100,000 baseline. But once the price starts appreciating, you start getting your returns returned quite impressively from there. So you can see there, as the price goes against us, we add more shares. There's the biggest amount of shares entered during that period when the price is going against us, and it finally closed out at that period there with a profitability of 9,255. We enter more shares there, the price goes against us, we start averaging down, we close out now, profitability of 11,992. There's another down period here, a number of years. We average down again, and the price closes up there at 18,599. So at the moment, you're still holding those shares, and the prices are depreciating slightly, but not substantially. But you can see there the end result, we've got 19,282 over the whole period versus 1,866. Now just bear in mind, our take profit is our primary source of revenue. Our secondary source of revenue, while the price is going down, the share price is going down, is gaining a dividend return on that share price, on that share. So that's why you need to buy blue chip shares. So when the price does go against you and you're holding that stock long term, you're receiving a dividend. So basically overall, you can see here for Ford, again, the average down approach is 19,200 versus 1,800 for the stop loss approach. So again, remember the stop loss approach is 10% take profit, 5% stop loss, or 10% profit on the average down, 5% decline before you average down more. This is General Motors. So again, same sort of logic. We start 100,000 baseline in this back testing. The price goes into the negative here, below 100,000 for the stop loss approach. And during the whole period since 2011, the ending balance for stop loss approach is 99,385. So we've dropped almost $1,000 or $700 roughly on the General Motors share price using the stop loss approach. Your profitability for the average down approach, it's currently sitting at 6,838. So as you can see there, the returns have paid off by averaging down. For Mercedes-Benz, you can see here the stop loss approach. We started off okay in the early years when the price was appreciating, but once the price started falling off, our profitability also fell off. So we finished up as of February 2023, we're sitting at 99,416 if our starting balance is 100,000. So we're down about $600 on Mercedes-Benz over that whole period. Using the average down approach, you can see there we went through a bit of a drawdown during that period there when the share price was declining. But we ultimately were sitting currently at 120,363, which is about 20,000 above our opening balance of 100,000. So 20,000 in a black versus $600 in the red for stop loss. You can see here Toyota has been in the red almost from day one, had you traded back since 1997. It's currently sitting at $98,400 roughly, so you're down almost a couple of grand on Toyota during the whole period. For the average down approach, we're finishing at 117,337, so we're up about 17,000 from our opening balance of 100,000. So you can see there the market difference between the two approaches. Lastly, Volkswagen. This is probably the most positive using the stop loss approach. Over the period since 1988 or 1997, you've been in a positive most of that time, and you're currently sitting at a profitability of 103,870. So basically a gain of 3,870 from our opening balance of 100,000. Using the average down approach, we went a bit of a drawdown during this period when the price was going down, but then it quickly came out of that period, and we've got a return of 124,491. So we're up 24,491. So 24,400 versus 3,800 for the stop loss. So I just want to emphasize again, we're using the very simple strategy of these two moving averages for our strategy. We have a whole lot of other strategies tested on Pete's Investing strategy channel, and I advise you to go and have a look at some of those strategies to get a better idea in terms of efficiency on getting the best dollar for your return on averaging down. Let me explain why that is the case and how to properly fine-tune when to get in when the price goes against you. You don't want to get in too often, and I'll explain that why now. So what I've got here, I've already explained to you these two strategies, the stop loss in the red, the average down using a 10% gain and a 5% decline for the average down in the black. This new one, I've applied a 10% gain to take profit, but instead of a 5% drop, I've allowed a 50% drop. So in other words, allow a bigger price drop before adding more shares to the trades. So you can see there, a couple of things happened. The major thing that's happened is your profitability drops because you're not investing as many shares in terms of your returns. So whereas the average down using the 10% gain and a 5% drop before averaging down returned 19,282. This is for Ford. The 10% gain and the 50% drop returned 4,986, which is still better than the stop loss strategy, but in other words, it's not having as big a drawdown impact on your funds. So you can see here on the 10% gain and a 5% decline before averaging down, your funds, had you traded this one stock only and you started with $100,000, your funds would have dropped to about $60,000. So you would have been in a drawdown at the most during that period of about $40,000. That period there, you would have been in a drawdown from that high to that low. You would have been down about $25,000, $30,000 as well. This one, less profitability, but notice the drawdown effect. From that high to that low, you're down to about $93,000. So in other words, the impact is not as great versus $60,000. Your funds would have dropped down to $60,000. In this example, your funds would have dropped down to about $93,000. You can see up here where you went to the negative again during this period with a 5% decline before adding. Here you're pretty much a very minor drawdown in your profitability with very minor shares added. So again, two things to consider: a smaller impact on your drawdown if you increase the size of the drop before adding more shares, but also you're decreasing your profitability. So in other words, the more shares you add to your trades as you average down, the higher the profitability. So you've got to understand that there's got to be a sweet spot where you're comfortable, where you're prepared to have some loss in your, or some hit to your drawdown, but also have a slightly less return on your revenue. These are some of my investing rules, which I show at all my videos at the tail end if you've stuck to the end of those. So buy proven blue chip stocks only to avoid speculative stocks, and that's to primarily receive dividends and improve your probability of that stock appreciating in value. And the reason you receive dividends as part of the strategy is, say if the stock price does fall against you while you're averaging down, you are receiving some level of income at least a couple of times a year. Don't short positions only, go long only. There may be some times when you want to go long, but primarily go long because if you go short on any positions and they pay dividends, you typically pay those dividends to those traders that go long in the opposite direction. And don't trade on news. Price is already factored in the share price. So if you read it in the papers, it's already been factored in the share price, and you're behind the eight ball because the insiders have already traded those stocks. Thanks for watching. Don't forget to click the subscribe and the like button and click the notification bell to get all updates. And we'll be posting these more updates throughout the week for normal market updates. If you want to support the channel and get daily updates to the markets, then subscribe to the Patreon page, and link is in the description below. Happy investing, and speak to you in the next video.